clients are facing a number of challenges around collateral management, but let me focus on one, I think, significant challenge. The demand for collateral is going to increase significantly with the regulations. And so therefore being able to access a client's inventory, to optimize that collateral and then post it is really important. So Citi holding $13 trillion of assets for our underlying clients, we really need to be able to allow our clients to mobilize those assets in the most efficient way. So we're really working on a number of things, including collaborations with other ICSDs, tri-party agents, also just internally holding those assets, and how do we ensure that we are efficiently helping clients to mobilize them. So our solutions really are ensuring that clients can leverage those assets at lowest cost and in a very efficient manner, especially given the intraday nature to which collateral is moving. Regulations are really going to drive a lot more collateral being needed in the system, and secondly, also just the types of collateral that are needed. As such, collateral transformation could become quite relevant to the market, because whilst institutions may have a lot of assets, do they really have the right type of assets which they're going to be obligated to deliver to the likes of the CCPs? So I think collateral transformation could become very relevant. In terms of how it generally works, institutions such as ourselves really act as an intermediary to bring together those institutions which have types of assets which the CCPs are looking for with those institutions that need those assets. And so it naturally leverages things like our securities finance business, which really have been doing collateral transformation for many years, but much more in the securities financing and broker-dealer space. And that same type of service is now going to be required by buy-side institutions, especially to raise cash for posting as variation margin, because naturally buy-side clients would be long securities and not necessarily long cash. Assets of high quality, $32 trillion of OECD government bonds do exist out there in the marketplace. Against that, various studies show that the regulations are likely to result in around $2 trillion of excess collateral needing to be posted. So in one sense, you could say maybe there won't be an increase in demand for assets for collateral purposes. However, those $32 trillion of assets are really held in central banks, in pension funds, maybe institutions which don't necessarily need them for collateral, and so therefore what's going to happen to those institutions that do need them? So in that regard, there may well be a need for assets from a collateral management point of view, because they don't sit in the right area where they're needed. So I think what the landscape will do in terms of a change is really for institutions to look far more broadly than they have before, and look at their inventory around the globe. So in the past, institutions may well have had sufficient assets in their Western entities to be able to deal with the demand. But now they may need to look further afield in terms of their Asia presence, their LATAM presence, and these are emerging markets where the countries, the institutions in those countries are becoming so much stronger. The quality of those assets is now in the sphere of the quality which the CCPs are demanding. So they could become a very good avenue in the future for helping the thirst for collateral.